Alibaba has just reported its earnings before the market open. It is down now 4% as it continues to plummet. It is down 26% over the last year. So let's find out today, is it still undervalued? What is going on with their earnings? And we will look at the updated price target, the intrinsic value, as well as our acceptable buy price given our investor margin of safety, as well as what Wall Street are forecasting over the next 12 months. We'll take a look at the actual earnings, take a deep dive to see where this company is heading over the next few years. We'll touch upon the institutions after this report, whether they are buying or have they stopped. We're going to take a look at some of their financial metrics, talk about their dividend safety. We'll also cover some insider buying. In fact, that did happen over the last few weeks. We'll talk about any insider selling that we can see when we run it through our screener. And we'll talk about some other companies in the Chinese market, how they are performing over the last few years, whether or not Alibaba is the only one in isolation that is having problems. And based on their latest quarterly report, we'll have a quick look at the health of the company, their updated cash versus total debt position, and we'll look to see where their revenues are heading over the next few years and how well they've performed in the more recent period, as well as their bottom line net income. So let's take a look. As we mentioned, currently $75 in the pre-market. It is down 26% over the last year. Over the last 10 years, we can see it is very, very low. In fact, 10 years ago today, it was trading at around $88, so not too far off the current trading price. And we do see it now when the market opens, it will be heading towards its 52-week low. The current trading 12-month yield is around 1.3% with a forward PE under 9. So in terms of their revenues, very quickly, for those that are new to the company, as always, we're looking for 3 to 7% growth year on year. 56 billion was reported in March 2019, 126 billion in 2023. So we can clearly see over the last 5 years, this company has grown. The top line has increased quite significantly, more than double. On a more granular level, we do know increases to 2022. It did then drop slightly in 2023. And we'll touch upon very soon the last 10 years percentage-wise too, whether or not this is still a fast-growing company. Bottom line, a bit of a different story. 13 billion reported in 2019, 10.5 billion reported in 2023. So their bottom line is in fact going the other way, although we did note it did increase from 2019 to 2021 before decreasing in 2022 and then a small increase in 2023. So their top line has been increasing over the last 5 years. Their bottom line, a little bit of a different story. Quick health check then. Total cash versus total debt. 79 billion worth of cash from their latest quarterly report. A lot more than what they had 5 years ago at 30 billion. So they do have a lot of cash sitting on their balance sheet. In terms of their total debt then, numerically and directionally, what we can see, it has gone from 20 billion in 2019 to 27 billion in their latest report. So they have a far big amount of cash to cover their total debt. If they wanted to, it wouldn't even take them 1 day. And again, we'll touch upon the net debt to EBITDA metric shortly too. So look, there are a few companies in the broadline retail industry. In fact, some also in the Chinese market. We have PDD, we have JD.com, we have Coupang, as well as a few others. Now, over the last year, we can see Alibaba has been one of the worst hit, down 25%. However, we do know there have been some that have performed very well. PDD, 34% up, and Meli up 45.5%. But we also know a few that are in the same market as Alibaba, the same country, in fact, down significantly as well. Now, when we extend this to the last 5 years, we see Baba as one of the worst performing, down 54%. But in actual fact, we see PDD up 349%. Meli, again, a very strong performance. However, with the others, we do see them negative or flat. So it's very interesting. We can see here that the Chinese market hasn't had the greatest last few years. And in fact, it will be interesting to see what the markets look like when they open, to see whether or not this report that we're about to go through is something that they like. Now, in terms of insider buying and selling, we have run it through a screener, a minimum 100 shares over the last few months, both buys and sells. Nothing has come up. However, what we notice now, Jack Ma, who used to be the co-founder, or was the co-founder in fact, as well as the chairman Joe say, they did buy a lot of shares over the last few weeks. In fact, Ma himself bought 50 million worth of the stock, and we can see that Chairman Joe did buy 151 million. So around 200 million worth of shares bought. So this is a bullish sign. They do expect to these shares to go up, otherwise they wouldn't have bought. But the interesting thing that I want to point out from this article is that we only recently covered around November 2023 that Jack Ma was looking to sell a lot of his shares. It does raise the question, is he now of the view that Alibaba shares will be going back up much higher, whereas before he was looking, as we ran through, to offload a lot of stock? So this could be a bullish sign in my opinion. Doesn't necessarily mean the share price is going to go up today or tomorrow. It could be a longer term vision that he has. In terms of institutional ownership, look, it's 40%. It isn't that much. We do see around 6 billion worth of sales by these institutions and a little bit more during the same period, 9 billion versus 6. What we do note though in the latest quarter, Q4 of 2023, that institutions did sell more than they did buy of Alibaba. Again, take all of this with a pinch of salt. Don't always copy what never copy what the institutions do. Always do your own due diligence. But we can see here over the last 12 months, more buying than selling. In the more recent quarter, however, there was more selling. So now, before we take a look at any of the financial metrics, let's take a very quick look at the essential report that did come out a few days ago. And we can see now it has come down to 5%. This share price could drop even further once the market opens. So we can see Alibaba shares whipsaw in the pre-market. Now, when it did first open, it was up 5%. Interestingly, now it is down 5% and it could go even further. As we can see here, they did miss on revenue, but they did plan 25 billion worth of a buyback program, which is nice to see. They do essentially believe that the shares are currently cheap, so they want to buy a significant amount of shares back. So let's take a look at the key point here. Alibaba had a tumultuous year in 2023. That is very obvious. We have seen their performance very, very poor. And we did see that in 23 they did change their CEO, as well as cancelling the spin-off that we did discuss on previous episodes of Alibaba. So in terms of the numbers then, how did they perform? So we can see when we take a look at the revenue, 260.35 billion Chinese yuan versus 262. So they did miss on revenue. When we did take a look, when the report came out, they did in fact beat on the earnings per share. So one beat, one miss. We do see the market now, it hasn't taken the news very positively, and it also incorporates that 25 billion share buyback program. Now, in terms of quarter on quarter and their net income, we can see that for December quarter, it did fall 69% year on year. Now, the reason they expect this to happen was due to the market changes. Now, again, lots of different things that you need to bear in mind with Alibaba: regulation, risk, especially with China. We've covered this a lot of times. There are a lot of short sellers in the Chinese market, which has brought down share prices, or in fact the whole market, lower and lower. We have covered that before as well. So in terms of other points here to note, there are a few points that we just want to bring out. The cloud computing business, their EBIT rose 86% year on year as they do focus on profitability, and we can see their international commerce business as well, up 44%. So lots of positives to note, as well as a few things to bear in mind. We will take a look now at the revenue, just to run through how that's looking year on year and whether or not we continue to expect their top line to increase. So in terms of dividend safety, as they've just started paying, we don't have a score just yet. Market cap 200 billion. It is a mega cap company. In terms of those metrics, so we look at the free cash flow payout. Now, given they've just started to pay out dividends, we only have 1 year worth of data. It will be 11% of their free cash flow. 2024 expected the same. What's nice to note, because it is very low, I would expect strong double-digit increases to their dividend, which is nice to see alongside those share buyback programs. Now, in terms of the free cash flow per share, always nice to see this very nice growth. Pretty consistent other than that 2022 drop that we do see. Pretty much 6 times growth over the last 10 years. 2024 expected to be slightly lower than 2023. Still looking very positive nonetheless. In terms of sales growth, this is one thing that I have mentioned before. It is a bit of a worry. They've had strong double-digit growth year on year up to 2022. Now, their latest annual report, it is down, or in fact, it is up 2%, down from the previous year of 19%. And in the report, they did state that their revenue quarter on quarter, I believe, is up 5%. So it will be interesting to see their future forward guidance, but it looks like the days of maybe double-digit increase to the top line may be slowing down. Nonetheless, brilliant growth over the period, but something just to consider if you are looking to invest, or if you are an investor, just to set those realistic expectations given management's forward guidance. and the 2023 year increase. So top line, it's gone from 53 billion in 2014, 915 over the last 12 months, with 2023 at 869. So you can see the phenomenal growth they've had year on year. Shares outstanding, yes, we love it when companies do share buybacks. What we actually see with Alibaba here is the opposite. They've issued shares, a net issuance over the last 10 years, increasing it from 2.33 billion to 2.59. In terms of the ROIC, I personally prefer to see 10% or more. Gives me faith management are able to effectively allocate their capital. 8 to 9% is something that I can live with. I would like to see it go back higher. We have seen them in the 11-12%, but 8% really is something that I would start to consider whether or not I would want to hold this company. Free cash flow margin, operating margin, both tell me a very similar story. Their margins are being suppressed year on year or being squeezed, going from 50% in 2014, 12% in 2023. A very similar story on the free cash flow margin. These are probably margins that I would look in the future to ensure that they haven't continued to drop, as when the operating margin drops lower and lower, so will that bottom line net income, which in return for investors, that dividend increase and those potential future share buybacks will become less common. In terms of the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, remember it shows us the balance sheet strength as well as dividend safety. So what we can see here, essentially it wouldn't even take them 1 day, as I mentioned earlier, to pay off all of their debt net of cash on hand. Now, before we jump into the valuation, just to let you know, we have released a free weekly newsletter. We are now on the 4th newsletter. Over the last few weeks, we've talked about undervalued companies with strong upsides, as well as running through our 7 golden dividend metrics for undervalued dividend screener. If you want access completely free, just click on that pinned comment below to sign up. So let's jump into the updated valuation for Alibaba given their earnings. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the Graham's valuation formula. Number 1, we have the earnings per share, we have the long-term growth rate, as well as the AAA corporate bond yield. Gives us an intrinsic value of $106. So we have our first sign of undervaluation. Bear in mind, we're not looking at any of these models in isolation. We then have the multiples valuation, average P of companies in a similar sector, multiplied by that of Baba, to get another undervaluation signal here. We then move on to the third model. Now, we haven't used the dividend discount model purely because it's only been 1 year since they have been paying dividends, so we would like a few more years worth of data before concluding. So we then use the discounted cash flow model, free cash flow year on year, average growth rate per analyst estimates. We've gone a lot more conservative at 1%. And we see the discount rate in combination. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here another significant undervaluation signal. Now, the intrinsic value for today's episode of Baba is the average of these 3 models, coming to $145. As always, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then click on that pinned comment below. As always, we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. So it would be a buy up to 130. At 15%, we can still see it's a buy. So there is a significant margin of safety with Baba at 45% up to $79. And if we go to 50%, you'd have to wait around $72.41. And as we can see, the stock is still in the pre-market and it is going down further and further now, $74.60. So it looks like it could be trading around $72 when the market opens, and that would be a margin of safety of 50%. In terms of Wall Street and their expectations, well, their revised price target is $120. They see upside of 60%, and they expect this over the next 12 months. As always, let me know your thoughts. Were you happy with this earnings? Is Baba one that you have on your watch list? Maybe you're waiting for it to go towards its 52-week low, or for whatever reason, maybe just the risk, the non-financial risk is too much for you to enter. As always, if you enjoyed the episode, smash that like button, hit the subscribe so you're continually notified of these videos as they drop. And as always, have a great day and see you on the next one.